So if U.S. house prices go down by 10%, that's one U.S. housing debt. Asian investors were buying U.S. housing debt. The Chinese government was buying U.S. housing debt. All of these people started to take a hit. What do you do when you start to lever against the U.S. housing market? When this started to happen, investment banks started to struggle. The first one to go was in March 2008. It was Bear Stearns, and I don't know if you'd be familiar, but it was probably the 8th largest investment bank at the time. It went from $80 a share, and we all breathed a sigh of relief. I'm glad somebody bailed us out. The economy's not going to go down the tubes. The only problem was the fundamental issue was still in place. There was too much debt on the U.S. housing market. The U.S. consumer had too much debt, and house prices were still dropping. And the next one, which everybody felt around the world, you could read local papers in Hong Kong, and everybody knew who Lehman Brothers. That's how much debt that they were allowed to have with U.S. regulations. When Lehman Brothers went bankrupt, then people started to get the idea, we have a real big problem here because we have a society that has been built on these low interest rates and a lot of leverage and housing prices that never have gone down. That paradigm has now shifted. And that takes a while to work itself out. The intraday bottom on the S&P, I know because I was watching it on a minute-by-minute basis, was 666. I won't draw any specific conclusions from that, but that ended up being where the S&P started to turn around. And the process that we've been going through now is really, I say turbulent, but not forgotten. If you lose a lot of money and you lose your job or you lose your house, you don't just bounce back from that. That takes a lot of time, a lot of healing, as it were. It leaves a lot of scars. I say in sort of a crass fashion, I'm not sure what a better local term would be, but it causes brain damage in a way. And that hasn't gone away. And so we're starting to see the markets return, but as you'll see, consistently, even through the tech wreck in 2001, people were buying stocks with a long-term view. Stocks will eventually come back. There will be growth. Well, after we got past the Lehman Brothers collapse, this is the zero line. Nobody wants to invest in equities. And actually, today, right now, is the worst net inflows, the worst money going into equities that we've seen in the last decade, which is odd because the market's actually started to recover. So normally, investors chase returns, but they're not doing it. And why are they not doing it? Because they just haven't forgotten the pain experienced by owning equities in the last couple of years. The yellow line is bonds. So what effectively you have is people buying bonds at 2.5% yields. If you buy U.S. government bonds, they're going to pay you 2.5%. Not very attractive. But yet people are buying bonds and they're selling equities. Why? Because there's still a lot of pain in the U.S. institutional community, U.S. institutional investor community. We're not quite there yet in terms of the markets being healed. The other way to measure how people are feeling is this blue line. It's called the VIX. The VIX is an index, and indices and prices are very important. You'll see this when the capital markets open up. Everybody will be watching your composite index, Olivier. They'll be wondering, is the stock market up or down today? And if it's down, they're going to blame you, so you should probably be ready for that. But the VIX itself is a volatility index. It is essentially a gauge of fear. It is the implied volatility that's being paid for in all the securities that are being traded, listed and over the counter in the developed markets. And so what you can see is that the VIX itself, if it's going down, there is a lot less fear. There's a lot of complacency. So in 1992, 3, 4, 5, there wasn't a lot of worry about what was going on in the global economy. That changed a little bit. The VIX went up for a period of time. And then we had the same very extended period of calm, 2003, 4, 5. 2006 it started to go up. People who were trading volatility, you can actually do that for a living. We're starting to see the housing market was starting to weaken. And so we actually saw a period of time where the VIX spiked. But look where it spiked to. This data is collected on a monthly basis. And actually, there were days where the VIX was actually, see where the red dot was? It was essentially off the charts. People were so scared, they didn't want to own securities. They didn't want to own any stocks. They would only short stocks. Shorting was banned for a while. It got very hectic. And so the fear index, as it were, basically went to record levels. We're back here. So we have improved, but we haven't got anything near. You see this number get back down to sort of a 12 or 13 level? Oh, that's great. Thank you. when we see this number get back down to the 12 or 13 level, you'll know that the financial markets have essentially healed themselves. Now, I want to transition a little bit to talking about something that's slightly more relevant, which is the emerging markets. Emerging markets are where you want to be invested. We manage a couple of $1 billion for our institutional clients. 20 years, this indice has gone from essentially a base of 1 to 34. You've had a 34 times increase if you just invested in local currency emerging market indices over that period. So you had a 9 times outperformance in the emerging markets. There's that much more growth. But I put it relative to the VIX because it's volatile, and when you get spikes in fear, capital flows out of emerging markets. Why is that even relevant for you? It's relevant because you have to understand that global investors, as they come into the market, will put capital in and they'll take capital out. It's not that damaging as long as the debt load of the businesses in that country are not too high. But the last thought on the turbulence that we've seen, I'm not making a forecast necessarily, but if you are investing, we think equities, stocks are much more attractive than bonds right now. People are putting money into bonds, they're fleeing equities, and yet these are the types of returns they're comparing. Microsoft, which is probably the most global company, certainly from a tech standpoint, but maybe even in the world. I've been actually scanning the laptops of the students. Everybody runs a Microsoft operating system. Some people run Apple, but mostly it's Microsoft. Microsoft issued a 5-year bond last week. The yield on their bond is 1.7%. If you buy a share of Microsoft stock, they'll pay you a dividend. The yield of that dividend compared to the stock price is 2.5%. You're getting paid more income to be an owner. So the bonds, in some sense, aren't even that much safer than the equities, and yet people are so afraid of stocks, they're willing to buy a bond at a discount to where they can get for the stock and have all the benefits of the earnings growth and being an owner in the returns. So it's just another sign that if you wanted to allocate your capital right now, it's probably better to be in equities. This is the S&P 500, which is the market overall. If you compare the earnings to the price of the S&P right now, the S&P is returning on itself earnings of about 6.5%. They're paying, the S&P 500 companies are paying out a little under a third of that. So S&P 500 companies are yielding close to 2%. If you give your money to the U.S. government, you're going to get back 2.5%, or compared to the 2% of the S&P 500. The companies that make up these dividend yields are companies like Intel, Apple, Google, Procter & Gamble, global multinational companies with net cash on their balance sheet. You don't have to be an economist to know that the U.S. government does not have net cash on its balance sheet. The U.S. government has debt that's approaching its GDP, has debt that's approaching $12 or $13 trillion. I would rather be buying the S&P 500 and getting 2% plus the potential for appreciation in the equities, rather than giving my money to a central bank where you can see the effectiveness of the policy if you start from a base